I think AI is absolutely real. I think it will change all of our lives in very significant and dramatic ways over the next 5 to 10 years. We're going to hit that zone of disillusionment.
Would you own a company where you really like their business model, but you don't love their CEO?
There's always a tendency on the part of young analysts to want to rush to conclusions. No one's going to remember whether it took you 6 months or 10 months to launch your first industry review. Take that time.
I'm Mike Gitlin. Welcome to another episode of our Capital Ideas podcast. Today we have Chris Buchbinder with us. He's been at Capital 29 years, right about as of today. So the big 30th anniversary is coming up soon. He's an equity portfolio manager based in San Francisco. Chris, welcome.
Thank you, Mike.
So I'm going to start with something that's very uniquely Capital Group. You joined us through the associate program, now known as CAP, or the Capital Associate Program. For folks that are listening and watching, can you tell us what the program actually is? Because there's a mystique a bit around it. Maybe share what it is for everyone.
Well, CAP, at the time TAP, was an amazing program. I came out of undergrad knowing I had an interest in finance, but not really knowing exactly what I wanted to do. I didn't have a family background in finance. I had worked a summer internship at a Payne Weber brokerage, which gave me a slight exposure, but not a lot.
Old school,
very old school. And what CAP is, TAP at the time, it's an opportunity to work over the course of 2 or 3 years in a series of different assignments, working assignments in the company where you're doing real work. And also at the same time, take a series of business school classes taught by professors from leading business schools that Capital hires. And so for me, this looked like a wonderful opportunity to essentially get paid to get the equivalent of an MBA. And I came to Capital thinking, okay, I'll be here for 2 or 3, maybe 4 years, and then I'll move on to the next thing. And obviously I misjudged that because I'm still here 29 years later.
Yeah, I misjudged you by about a quarter of a century. So you joined that program, and then you became an analyst. You became an equity analyst just around the time of the TMT bubble burst. So you took on telcos. Timing wasn't perfect, but maybe it was educational in some ways. Tell us about that transition.
So I came out of the TAP program at the end of 1997, and they offered me a role as an analyst covering the telecom industry. And I said, yes, please, I'll take it. And this was actually, there was a period of time when the bubble was still inflating. So people often talk about the internet bubble of the late 1990s, early 2000s. What they sometimes forget is actually, but I do not forget, is that the bubble was much larger and more severe when it popped in the telecom industry. So my first 2 years, 98, 99, were great. Every stock I picked went up a lot.
Brilliant, right?
I was brilliant. I knew I was brilliant.
You nailed it.
Then we got to the experience of 2000 and things didn't work out quite as well.
Right.
And so the experience of, kind of living through both the inflating of the buzz of the bubble and sort of seeing the enthusiasm, and, to a degree, recklessness in the market. And then the experience of the bursting of the bubble and then the multi-year aftermath of that was really, really educational for me. And I guess, a few lessons I learned there. One, when you get into these bubble periods, it is easy to underestimate how deeply it penetrates an industry. So for instance, I invested in early 2000, I sort of gravitated towards the leading companies in the industry, the higher quality ones. I avoided the speculative ones.
And that was feeling as if this is valuations are rich.
Exactly.
We're getting close to the end here.
Getting close to the end. And what that allowed me to do when the bubble burst is lose less money than I otherwise would have lost. But I still lost a lot of money up for our shareholders. And that was an error. Then about a year and a half later, I decided, well, there must be some opportunities in this wreckage. And many of the stocks were down 80%, started investing. And what I learned is just because the stock is down 80% doesn't mean it can't go down another 80%. So I had a few of those. That wasn't so much fun. But the last lesson I learned, which I think has been very informative for my subsequent career, is after WorldCom declared bankruptcy, the market just gave up on the telecom industry. And this was 2001, kind of after the bursting of the bubble. And every telecom company that had debt was treated as if it was going to go bankrupt. And there were some incredible investment opportunities during that period, particularly in the wireless industry, multi-baggers. And that was something that I was fortunate enough to be able to take advantage of. So I learned a lot of hard lessons and some good lessons.
Well, same thing. I'm sure you found that when you later became a diversified portfolio manager after the global financial crisis in the financial sector. We'll get into that, but those lessons of finding some gems throughout a crisis after it probably held well. I want to talk about becoming an auto analyst. And trouble seems to follow you. So you became an auto analyst in the early 2000s. A few years thereafter, two of the three largest declared bankruptcy. So we have to be careful of what Chris Buchbinder covers as an analyst. But talk about that transition and picking up autos during that period.
Well, first of all, I started working on the auto industry in 2001. So it was in the midst of all the turmoil in telecom. So that was a busy period for me. But I covered that industry, really through 2012. And as you said, two of the three largest companies went bankrupt. Ford did not go bankrupt. I was sure they were going to, but they were managed to skate out. The largest supplier, which we were unfortunately invested in, did go bankrupt. So that was another unfortunate lesson that I learned. But there were some, again, incredible opportunities during the depths of the GFC, global financial crisis. So I had the opportunity, very interestingly, wasn't official testimony, but go in and speak to congressional leadership when they were restructuring the auto industry and lay out some of my ideas around what they needed to do. And one of the things that was kind of gratifying is they ended up implementing some of those ideas.
I didn't know that. That's interesting.
Not all of them, but some of them. But during that period, again, very similar to the telecom debacle earlier, there's some wonderful opportunities in great companies like Johnson Controls and Harley Davidson, where they were trading at kind of single-digit stock prices. And these were companies that were going to be able to make it through and had enduring franchises. And again, it was just an opportunity to take advantage of that, period of despair.
So timing's everything. 2007 comes along, you become a diversified portfolio manager. We all know in 2008, the global financial crisis hits, but you had been through a couple battles, right? You've been through the TMT bubble bursting, you've been through the auto crisis. You're just becoming a diversified PM, and we have this large global financial crisis, which we all know now how it played out, but live time, all of us had no idea what would happen ultimately. Talk about that transition and how it really led to your process now as a portfolio manager.
Yeah, that's a good question. So first of all, just to continue with the theme, I started as a diversified portfolio manager October of 2007, literally the exact month the market peaked before declining, 50% plus in the GFC. So again, wonderful timing. And that was a difficult time to start, particularly for someone with the investment style that I have, which is where I do sort of look for the contrarian opportunities. That was not a time to be contrarian. What you wanted to do was be very conservative, invest in the most defensive companies.
Avoid the blow up.
Avoid the blow ups and avoid anything, even good companies that had, risk in their business. And I didn't do enough of that. But on the other side, again, one of the great investments that I had, and I've had many blow ups, but one of the great investments I had as a portfolio manager during that period was in Home Depot. And our analysts had been doing great work on it and had come to the conclusion that kind of management was transitioning and improving, but they were really at the epicenter of the crisis. Remember, this was a housing crisis that led to the financial crisis, and the market was convinced that housing was never going to come back anytime soon. And as a result, Home Depot was incredibly discounted. And it turned out to be an incredible investment opportunity because, as the crisis eased, what became clear was not only was this a cyclical investment opportunity, but it then became a secular compounder. And that's really, I think, the experience that has informed my investment style. I'll still invest in cyclical turnarounds where I don't have as much confidence in the long term. But what I'm really looking for are opportunities to invest in companies with great bones during periods of time when the external environment has created an atmosphere of crisis.
So that gets to investment edge, right? That concept of your process and your edge, and everyone has a unique both process and what makes them special as an investor. Is that your investment edge, or how would you describe it to everyone?
I'd say generally I look for opportunities when other people see despair. And what I like to say is My favorite investment opportunities are ones where any educated person can pick up the newspaper and know why they should not invest in a certain company or industry, but our insight or analysis leads us to the opposite conclusion. The additional piece that I've added over time is if I can find those opportunities in companies that have those great bones that I talked about, then you really have sort of a double whammy. You have the opportunity for an easing of the crisis and a revaluation and improvement in financial results as the crisis eases. And then that can turn into a multi-year compounder. Again, not every investment can be that, but that's what I look for.
And so that means that a lot of times you'll be early.
Yes.
As a contrarian investor
Yes.
looking, but so how do you feel comfortable in knowing you may be early, knowing you probably can't own your optimal position right away and you'll have to average down as you're early to the idea or the concept? How in Capital Group in our culture can you do that? Is that talk about the ability to stay in there when it gets hard?
Yeah. Well, it's a good question. I guess the first thing I'd say is it's really important to emphasize that working with the analyst is a critical part of my investment process. So often by the time I'm getting interested in an industry or a company, our analyst has been working on for years, often been invested. Sometimes they've been wrong for temporary reasons. The pandemic hits, and if you're a airline company or a aircraft engine manufacturer, your business doesn't look so good. That's not the analyst's fault. But I then sort of work with what the existing pool of analyst convictions are and look for those opportunities. And what I've learned about myself over time is I often see the opportunities before everybody else does, which often means that they're not quite ripe from an investment perspective. So I typically try to go slow. I typically try and start a little later than I might otherwise have started earlier in my career. And as you start with smaller positions, and as either fundamentals begin to improve and the market sort of validates that I'm right in the thesis of the turnaround, or the valuation comes down and fundamentals remain the same, then I sort of gradually increase. So I can be wrong for a period of time as long as all the other portfolio managers aren't doing the exact same thing that I do, and they usually are not. They usually are not. Then the fund can continue to do well during that period, even if I might go through a period of weaker results.
What's interesting about that, we had Mark Casey as a guest, and you two have different investment styles, but similar mentality of being willing to be early, willing to be wrong before you're right, sticking through it, and then having those compounders, as you say, longer term. It's interesting how you end up with a very different investment style, but a similar process in that.
Yeah.
The market right now, the stock market right now, in particular in the US, very narrow, but beginning to broaden. So that's coming your way. As someone who's a bit of a contrarian, that is coming your way. How do you think of the broad market opportunities? And then maybe we'll dig into a few ideas.
Yeah. Well, the first thing I'd say is I try not to be doctrinaire. So I do have investments in some of the leading growth companies, and I think there are ways in which some of those companies are underappreciated. However, I would say that we went through a period of time, 10 years, give or take, where we kind of had zero interest rates for an extended period. And in that environment, what you really wanted to invest in were great growth companies that had big moats, because the market, not only would you get the earnings compounding, but the market would just gradually increase their valuation because, with zero interest rates as a comparison, there really was sort of no cap on valuations. I think that period is over. I think we've got sustainably, higher interest rates, which will lead to a cap on valuations. And I think what that means is you need to be a little more discriminating with respect to thinking about market expectations versus what you anticipate unfolding. And what I'd observe right now is there's a great amount of enthusiasm around AI, just as there was a great amount of enthusiasm around the internet in 2000. I think AI is absolutely real. I think it will change all of our lives in very significant, dramatic ways over the next 5 to 10 years, just as the internet was real and changed our lives in very significant ways. And I think sometime over the next 12, 24 months, somewhere in there, we're going to hit that zone of disillusionment. And that's the period of time in any sort of growth trend where things begin to slow a little bit. and the market becomes disaffected. Valuations may compress. The fundamentals may, even though the fundamentals may end up being great, the fundamentals may slow for a period of time, and you often get very extreme stock reactions.
Like we had in the internet.
And we had a little bit of this in 22, so you don't have to go all the way back to 2020. It can still happen in the modern era, or to 2000 rather. On the flip side, the economy has sort of powered through what many people thought would be a recession at this point, and it seems like that's going to continue. And this, maybe we'll get into some of the stock ideas next, there's also a set of industries that were really hard hit during the pandemic that are in multi-year recovery. So not only do you have a robust economy, but you've got this underlying trend of a multi-year recovery. And I see a lot of opportunities in that set of companies. And some of them are appreciated, but they're not the market darlings right now. And I think you've got some pretty good multi-year investments there.
Okay, so let's dig into some individual ideas and companies that you own. I preface it and say you can't have any open orders right now on the trading desk, but tell us a couple ideas right now.
Yeah. Well, I'll talk about a few, and a couple of these are ideas that actually entered the portfolio during 2020 in the depths of the pandemic. And during that period of time, if we rewind a little bit, everything was shut down. So cruise lines were not cruising, airplanes were not flying, and that created some opportunities in Royal Caribbean, really the leading cruise line. And our analysts, again, to use the model I described earlier, our analysts knew the cruise industry extremely well, continues to know it extremely well, knew the best management team in the industry. And working with our fixed income analysts and our equity analysts, we gained confidence during that period that they could make it through.
Liquidity. They would have enough liquidity to
they
make
had
it
the balance sheet to make it through the crisis. And if we knew they would make it through the crisis, we didn't know exactly how much they'd earn on the other side, but we knew they'd earn a lot more than the market seemed to be currently discounting. And so we invested then. It's continued to be a big holding for me, and it is a big holding today. And I think we are in a multi-year recovery period for leisure travel, and they're the leading company in the cruise line industry. Another example, somewhat similar setup, is General Electric. So GE was in the depths of 2020, was still sort of an over-levered conglomerate. They had a great relatively new CEO in Larry Culp, longtime CEO of Danaher. But the market was very uncertain about his ability to really affect change in the company. And their primary business, which is kind of a razor and blades business, you sell aircraft engines, break even, little profit, little loss, and then you make all your money on the service and maintenance revenue streams. The problem is when planes aren't flying, you don't get those service and maintenance revenue streams. And so the market was very concerned about the outlook for GE. Again, working with our analysts, we understood that they were the leading aircraft engine manufacturer in the world. There's not going to be another one. There's no new entrants in that business, and planes will fly again. And we knew that they'd be able to, or we were confident, we didn't know, we've gained confidence they'd be able to make it through from a balance sheet perspective. And now, a few years later, there's been an amazing transformation. I think GE is widely acknowledged to be the leading, if not the leading, one of the leading aerospace companies in the world with a fantastic CEO. They've spun off a couple of their other businesses. And because of everything that happened during the pandemic in terms of lack of ordering of new planes, we've got a multi-year, I think of it as sort of a super cycle in the aerospace industry.
So you mentioned Larry Culp as a CEO that you respect. Would you own a company where you really like their business model, but you don't love their CEO?
The answer is yes, although those are not my favorite investments. But one of the patterns that I've learned I can make money for our shareholders in investing in is, when you go from, particularly in companies that may be either in a good industry or perhaps in a difficult time for an industry, but the environment's improving. If you've got perhaps a mediocre CEO, but who's getting better, or perhaps you've, got a team that's made a bunch of mistakes, but their decision-making is improving,
right?
Going from bad to less bad or less bad to a little good can be a great investment. I also love to invest in companies with great management. I think that's very important, but you can do it. You can make money in both ways.
Got it. Well, those are interesting ideas. I want to pivot now and tell you what I stole from your office. And I'm going to ask you in our office treasure hunt to describe it for our Listeners, we have viewers and listeners. Our viewers can obviously see it, but I'm going to hand you a lucite and maybe tell us what it is and why it's in your office.
Yeah, this is special to me on a couple of different levels. So what this is, it's a lucite block that says Cogent Communications, July of 2000. And this is what they give you if you're part of the group of investors investing in a private placement. Sometimes you get them for IPOs as well. And we made a private investment in Cogent Communications in July of 2000. And I made this investment, or really Brad Vogt and I made this investment. And Brad at the time was the other telecom analyst. When I came into the industry, he'd already been covering the industry for 5 or 6 years, and we worked very closely together. And he was a great partner and, in some ways a mentor for a number of years. And unfortunately, he passed away last year. And so, to a degree, I always remember him when I look at this. I think one of the special things about Capital is that the knowledge that we pass from analyst to analyst, and because people stay here for so long, people don't leave and it's out the door. Brad was the prior telecom analyst. We worked together and he passed knowledge to me, and then I passed knowledge to Brad Barrett, who took on the industry after I did. And that's incredibly valuable. And Brad was a great cultural leader in the right way to do that. The other thing I'll mention is we lost money on this investment. This was not a great investment. And it's an investment that we made during a period of time when there was huge enthusiasm over the internet and all the internet traffic it would bring. And that was Cogent's business. And that internet traffic came, but it was not a great investment. And it's a reminder that you can have great themes, great industry developments, fantastic growth, and still lose money if you're not careful about the risks involved.
It's a great lesson in investing, and I'm glad you brought up Brad's name. Brad Vogt was a portfolio manager and a leader at Capital Group for a very long time, and he did sadly pass away last year. But I think one of his legacies are folks like you. So many people Brad mentored, and he's helped Capital Group be a better place. So his family knows that, and we like to remind them often on how special Brad was to Capital Group.
Absolutely.
So let's talk about you as a research director. Research directors at Capital Group, it's not a full-time job, meaning you invest and you also are a research director and guide analyst. You would say it's a full-time job and you had another full-time job, and every research director claims they ultimately have 2 or 3 full-time jobs. But talk about being a research director and how you mentor analysts, and also maybe what are the most common mistakes new analysts make?
Yeah. Well, first of all, I'll say I was a research director for about 6 years, and I loved it. You're working with energetic, smart, young people who really want to be successful and effective and make an impact in our business. And, your job is to help guide them and, to the extent that you can. 2 pieces of advice that I always gave analysts, one that I gave them all the time and one that I learned a little later and have continued to convey. But the first was to always take more time than you need when you're launching initially. Our model here is for our analysts to be the industry experts, to be, as knowledgeable as anyone in the world. And there's always a tendency on the part of young analysts to want to rush to conclusions, to rush to kind of launching, to rush to invest, to launch, to rush to want to be part of the process. And what I would always tell them is no one's going to remember whether it took you 6 months or 10 months to launch your first industry review, but they'll remember your recommendations and they'll remember whether you were right or wrong. Take that time. And generally, people took me up on that advice. And again, if we want people to be the world's leading experts, we shouldn't worry so much if it takes them a few more months to launch.
It's such a differentiator, I think, for Capital Group. The need to be quote unquote productive is not there right away. It's the need to be really well researched and be able to add value to the process as opposed to being fast.
Yeah, long-term productive rather than short-term productive.
And so is that the mistake that folks make most often? Is it's the rushing to a conclusion, or as they launch and they've been covering an industry for a few years, an investor in that industry for a few years, is there a common mistake that you see that says this is what causes a challenge, an issue?
Well, there's a quote that Blair Frank, one of our longtime portfolio managers, made at a retreat, and I think there's a lot of wisdom in this quote. And this is one of the things I've tried to convey, both when I was a research director and now just as a portfolio manager to younger analysts, which is it's really important for analysts to do what they think is right, not what they think someone else wants them to do or what they think someone else thinks is right. And the message there really is our system relies on the analyst being an independent, very knowledgeable, thoughtful voice. And if an analyst comes to me or any other experienced portfolio manager and says, well, Chris, what do you think? And relies on my opinion to be the driver of their opinion, we lose the value of that independence voice. I may disagree with them. I may reach a different conclusion based on their analysis and insight, but their voice needs to be their own. And, in many organizations, things are hierarchical, right? You sort of figure out what your boss wants you to do, and you try and kind of do that and do it well. We have some of that, but really the intent here is for people to be independent thinkers and independent actors, and for the analysts in particular to be independent. And it's so important that they do what they think is right.
Right. So analysts are investors. They're not stock raters or credit raters. They invest real client assets, and you want them to have the conviction, right, in their ideas and not necessarily try to test them on you before they come to one of their conclusions. They could collaborate with you, ask you some of your ideas, but you want their ideas.
I want their ideas. And testing is fine, but they should be their ideas. And it's so important, just to highlight that here, analysts work with portfolio managers, not for portfolio managers.
Which is very different than elsewhere.
Very different.
That lack of hierarchy, you're investing alongside. That's a special part of Capital Group. I agree. Speaking of special parts of Capital Group, give us a mentor that you think about and respect. We talked about Brad, and I know he's one of your mentors. Give us another.
So there are a couple portfolio managers that I worked with early in my career that had a big impact on how I kind of approached the job. In some cases, how I approach investing, but in many ways, just how I approached the job. And those were Jim Dutton and Jim Drasdow. And they couldn't be, Jim Dutton has sadly passed away. Jim Drasdow is retired now. They couldn't be more different as people. Jim Dutton was sort of an old school portfolio manager, came to work every day in a coat and tie, never took his coat off at work, never, not once. He had walls of graph paper on his office, and he would track economic statistics and market internals by hand every day on that graph paper.
So he would make the line move.
He would make the line move, and he would gain insight from making those lines move. But he also brought, and he had a little bit of a gruff exterior, but he had a heart of gold. But he was a very methodical portfolio manager. He worked incredibly hard, even 40 years into his career. He was always at the office, always paying attention, always reading what the analysts wrote, and always bringing his own perspective as well to the process. Very methodical.
Disciplined.
Very disciplined. Jim Drasdow, I would describe as sort of an inspired investor. Jim had the ability, probably still has the ability in his personal investing, to sort of envision what the world's going to look like in 2 or 3 years and invest ahead of that in ways that I've never seen from others before or since. And he had this thing that he'd like to invest in that he called kickers, which is essentially the idea of investing in situations where there's a free option, something that's present in a company that the market doesn't appreciate, but in the world that he envisioned in 2 or 3 years, it could be really valuable. And again, I don't know anyone who saw that world more accurately than he did, and his investment record reflected that. I'm not the investor that Jim Drasdow was, but I try to do some of that in what I do.
That's great. When you got to Capital in the 1990s, you joined a fantasy baseball league. And a lot of Americans do fantasy football now. It's a huge thing. But back 27 years ago, fantasy baseball wasn't a big thing, and it was very manual for most people. But tell us about that experience as a new Capital Group joiner and getting involved with a legend at Capital Group.
So this was a very funny experience. And as you said, this was back in the day when the fantasy baseball was all done by hand. You would send in your rosters via the mail to a service that would send you, I guess they would send emails back with your scores like once a week. But someone sent out, this was in my first year as an analyst, somebody sent out a message. This was actually in the early days of using email here.
So around 96, 97.
And said, hey, does anyone want to join a fantasy baseball league? And, it was mostly, I said yes, a few other people who were in years 0 through 6 as analysts. And then our CEO at the time, John Lovelace, son of the founder, the person who's really, I would sort of credit with defining the modern version of capital, also said he'd like to play. So we had a bunch of junior analysts and John Lovelace in this fantasy baseball league. And we decided to do our draft at Fantasy Draft, where we picked the players who are going to be on our teams, at a dive bar in Santa Monica. And our CEO and very successful, leader comes to this dive bar, just like all the rest of us, with his list of players he wants to draft in the order. And we kept this up for, many years. And this was an incredibly powerful cultural message. And he didn't mean it as a message, just who he was. Mm-hmm. But the message he was conveying implicitly through his behavior is, we're a flat organization. I don't put myself above you. And we're all working together for the common good of the investors in our funds. And, I've tried to carry that spirit forward with me as I've worked with capital for these almost 29 years.
Yeah, it's such an important part of our culture. We're going to finish up with our obsessively grateful moment, where we do give you a very fancy mug that you can keep. While you're thinking of this, I will share one with you. Mm-hmm. Because it's the summer, I'm grateful that it's the summer. I'm grateful to take a little time off. A lot of us at Capital Group, the vast majority of us need that time. And being able to have some time where I can spend with family and think a little bit less about work is a good thing for mental health. So I'm glad it's the summer and have a little time with family. What are you grateful for?
Well, it's maybe to pick up on that theme, I'd say I'm grateful for my family. They say that one of the most important decisions you make in your life is who you marry. And I'm incredibly blessed. My wife, Nina, has been an amazing partner. And our 4 kids, Holden, Reese, Jude, and Dane, often challenging, a lot of work, but they're wonderful. And they make my life and our lives so much richer.
That's great. 4 boys. You're in the heart of it right now, Chris. Well, I appreciate you joining us. A lot of insights shared, a great career that you've had at Capital Group, and a lot left to go. So thank you. And I'll thank everyone for watching and listening. Please subscribe to Capital Group on YouTube or wherever you get your podcasts. And I hope you join us at our next Capital Ideas podcast, where we get to meet our portfolio managers and analysts. Have a great day.